Welcome back everyone, and the day has finally arrived where Novo Nordisk have released their earnings. Now factor in the last week the market has been pretty red. We're talking widespread in the S&P, but also in the healthcare sector. Nearly every company is continuing the downward trend. And actually, when we zoom out to the last year, the last 52 weeks, bit of a different story. Rest of the market looking strong, but again, healthcare continues to be punished. Now, at a very high level, when we take a look at Novo Nordisk's performance, on both headlines they missed, although we're talking fairly marginally. EPS was a 2-cent miss, and revenue we're talking just a couple of 100 million. If we take a step back though, both EPS and revenue are up double digit, earnings per share 39%, revenue up 20%, and we're going to get later into the episode in an understanding from their investor presentation, where is the company heading, should we be worried, or in fact, is this giving us signs of potential optimism? Factor in as well though, this company has been hit hard in just the last few months. We had the CEO being pushed out, questions around the weight loss market. Is this one that is now finally slipping away from NVO? And also issues around competition, the likes of Hims, as well as other cheaper alternatives. So there's a real question for Novo Nordisk, where is this company heading? And actually you can already see investors are getting a bit worried. Now the earnings report that we're going to go through can already shed some light into what investors think. It's down 2% in the pre-market, but honestly this company has had no love over the last year, down 63%, really trading a bit like a meme coin. 63% is ridiculous. Year to date, also a bit of a joke, 45%. Now this can give us a few different scenarios moving forwards. Great opportunity, or in fact a falling knife. Is this going to vanish into thin air? Likely that won't be the case. Now over the last 10 years, it is up 64%. We're going to compare it to the S&P and QQQ, but pretty obvious it has underperformed. Now when it does open, we're talking about another 52-week low, which is absolutely incredible for a company with the growth that we're seeing from Novo Nordisk. And if we take a look at the 52-week high, $140, that feels like we're talking in the 1800s. That was such a long time ago. Now, Seeking Alpha are the only ones still who have this as a buy with a 4.14 out of 5. That is fairly attractive in terms of where they see this in their portfolio. Wall Street, though, they're sticking with their hold rating. Now, before we get into the earnings in more depth, quick valuation snippet, which ultimately at the end, we're going to look at our own DCF process. But forward P sits at 12, well below the 5-year average of 30.4. Also, bear in mind, when the market opens, new 52-week low, this will be in the 11s. In fact, as we'll come to highlight, this is one of the lowest forward Ps, not just in the last 5 years, not just in the last 10 years, but in fact, in the last 20. We're talking severe undervaluation. Bear in mind, though, we don't look at these models in isolation. Yield super attractive now, probably going to open around 3.5%, well above the 5-year average of 1.41. Again, another severe undervaluation indicator. Now, given the fact that the yield is very high, well above historicals, we should reiterate dividend so far does look to be safe, in fact very safe, a score of 90 sitting here, but being transparent, it was in fact downgraded after we saw the cut to their guidance. Still looking very safe, but something we should just highlight. And you can notice here, very safe score highlights that a dividend cut for now looks to be highly unlikely. The other thing that's worth mentioning is when we take a look at the blue tunnel, which signals the intrinsic price, we're seeing severe undervaluation. The share price now well below even the bottom end of the blue tunnel. Again, looking very ridiculous solely if you factor valuation, because the blue tunnel has been increasing over the longer term, meaning the fair price, it's worth more and more as time has gone on, but the market is mispricing it. We're seeing no investor love. The actual value of the company is decreasing, and this gap is typically where real opportunity lies if you believe in the company for the longer term. And in fact, if we zoom out to the last 5 years, you can see this is a company more often than not that trades in severe overvaluation, where in fact it sits above the upper end of the blue tunnel. Only really in 2025 has this company entered into a severe undervaluation. And what makes it even more attractive now is when we compare the PE against the sector median of 17, this is now trading at a 29% discount. As we've highlighted just minutes ago, it's also trading at a very large discount to their own 5-year average. But now pretty much no matter what valuation metric you take a look at, whether it's against the sector or against their own historical averages, Novo Nordisk is trading at a very large discount. And if we just go back to around 2008, there were very rare instances where this company has been trading at a P ratio around the 12 mark. In fact, it was there in 2017 and in 2009. And if you had bought at those points, you can see it would have potentially been a very good opportunity. Something worth flagging, although we never really look at valuation in its isolation. And now if we just get to some of the headlines about their earnings, we can see here drug sales up 67%, and that is quite good, even though there has been a lot of issues, a lot of noise around competition from cheaper compounded drug makers. And as we highlighted, we did an episode as well, which as we'll come to, has affected the share price. They cut their full year guidance just last week. They introduced a new CEO. And one thing they are discussing now is around cutting costs and really focusing on efficiencies right across the board. And we can see that this increase is actually a very good sign, because a lot of the issues that were affecting their growth expectations were around copycats coming out with cheaper versions, and that ultimately led to them cutting their guidance. Now, some people will sit there and argue the new CEO has come in, perhaps sandbagging the numbers, and we will see some very large beats against the full year expectations, but so far looking good. But one thing we also really need to think about is Donald Trump and what will happen with a lot of the talks, not just around tariffs, but also pressurizing firms to lower their drug prices. And why this is an issue for companies like Novo Nordisk is because if we just step back and look at the comparisons, for example, the US, where Donald Trump is pressuring companies to lower prices, against Europe, you can see significant disparity. So Ozempic, which comes under Novo Nordisk, currently costs around $1,000 per month. Putting that into perspective, we have France, Germany, Denmark, UK sitting around the $100 mark. So Ozempic, as mentioned here, 5 to 15 times more expensive in the US than in many European countries, and with the US paying 256% more than other countries, is really a worry now for investors, because if they pressurize and they manage to lower the prices of Ozempic and other drug-related items, this will ultimately really take a hit to Novo Nordisk's top line. Something we want to just bring to your attention so it is there when you're considering your overall investment thesis. And looking at the investor presentation that was released today, we can also see them mentioning it here that their GLP-1 class growth is slowing down compared to prior years, which has ultimately led them to cut their guidance. But the numbers are still very strong. We're now actually comparing the first 6 months of 25 against 2024. We can see here top line up 16%. Nice to see. We should flag though, gross margin is down from 85% to around 83%. Operating profit up 25%, and actually we see the opposite. We see their operating margin climb up, which means they've been able to reduce their costs, so that is a positive note. And bottom line up 22%, their earnings per share up 23%. So yes, whilst they've cut their guidance, so far numbers are looking good. Investors will want to see that growth continue, but ultimately their cut was fairly significant, expecting 13 to 21%. This was now lowered down to 8 to 14. So that is quite a very substantial jump. Before they were essentially guaranteeing double-digit growth. Now they're saying at a bare minimum it's going to be high single digit, and that's also affected their operating growth. 10 to 16 now expected. Previously this was 16 to 24. The other thing that's really hurt their overall valuation when we come to our DCF model, regular viewers will know we use the free cash flow. That is why we've seen a substantial drop in the expected value. They now have free cash flow 35 to 45 billion. Prior to that, a lot higher, 56 to 66 billion. They do still, however, see themselves as market leaders when we look at a few different areas. We're talking diabetes, we're talking obesity, as well as haemophilia. So this isn't a dying company. Yes, maybe if you just looked at the share price, that is what would come into mind, that the company is going to fade away into the abyss, but still, this is one that holds a fairly substantial position across a wide range of markets. And also, when we look at their R&D, they do have a lot in the pipeline. Whilst personally not qualified to really discuss what each of one of these are, we can see at a high level it covers pretty much a lot of areas under the company: diabetes, obesity, rare disease, as well as CETA. And if you want to get down into more of the detail, we can see here there's quite a lot that's not just been submitted, which is ultimately further along than phase 1, 2 and 3, but a lot that has been approved, and we will see these into the market and ultimately into their revenue. And another thing that gets discussed quite a lot is around the patents. Novo Nordisk, how many years left do they have on each of their products? And we can see the main one, effectively Ozempic, they have an EU-US protection 2031 to 32, so we're still talking quite some way away, and that's also reflected on a vast majority of other products that they do hold. In fact, the most recent one that will be out of the patent, we can see here 27, 28, still a few years away. And whilst we're still waiting on super investors to release their latest 13F filings to see if they've been adding companies that have been hit hard, for example Novo Nordisk, UNH, as well as many others, we can see so far just one has come through, not a sell, in fact adding more to their portfolio. Markle Group adding 5%. Yes, it isn't a massive change to their overall portfolio, but something we thought we would highlight. And likewise for consistency, institutions, we've got a bit more data, 12% ownership. They sold 5.8 billion in the last year. They've now been buying more, 7.3 billion. Not just that, they're also net buyers again in Q2, buying just over $1 billion, selling 362 million. So clear and obvious, over the longer term, they have been buying a lot more than they have been selling. Yes, Q1, we actually saw the opposite, but they've now changed their stance. In Q2, they've been buying more. And growth still does look to be strong. They do in fact though get a D grade. Revenue last year was 24%, well above the sector and an improvement to their 5-year average. Now forward looking, as we've highlighted, has been hit, so estimations will be lower than this, but nonetheless the new updated is still going to be above the sector, which is actually interesting when you think about it, because they're valued at such a significant discount, and against their own 5-year probably will be there or thereabouts. Earnings per share though, that is what has ultimately taken a hit, probably leading a large percentage to the D on growth. 3 to 5 years projected 8 to 9%, little bit below the sector at 10.5%, but ultimately quite some way away from their historical 15%. And likewise, if we look at profitability, best score obtainable at an A+, gross margin 85%, well above the sector at 59%, marginally higher than the 5-year at 84%. Bottom line though, looking good, 35.5%, when the sector continues to burn through cash, -1%, and we see a little bit higher than their 5-year average, so definitely, even though it's small, we are noticing efficiencies. Cash from operations as well, 19 billion, well above their 5-year of 12, and again, sector burning through cash does look like a fairly attractive opportunity, solely in comparison to the sector where they're trading at such a significant discount. Now they did just report Q2 earnings, so in fact they did outperform as we highlighted, and if we look at the last 4 quarters, they now have a 100% track record. Against the last 5, we still note 4 out of 5 beats, so that is fairly solid, and they expect growth to continue into the next 2 quarters, ultimately ending 2025 fairly strongly. And if they do hit the EPS for 2026, this is a company that will be trading on a forward P in the 11 region. Now, as we said, we'll highlight the performance against the S&P and QQQ, where even reinvesting dividends, you would be down 62% in the last year. S&P up 21, QQQ up 29. That underperformance still continues, up 57, S&P up 90, QQQ up 113. And over the last 10 years, again, although a lot of this has come from the drop we saw in just the last year, nonetheless though, 100% S&P up more than 200, QQ up 448, but factor in past performance is not an indicator of the future. And likewise, we can show you against others like Merck & Co. in the pharma industry how they performed. Main reason why we do this, understand issue related to NVO or in fact the wider industry, and we can clearly see the majority of these have returned negative in just the last year. Definitely not a place you would have wanted to park your money. And over the last 5 years, whilst NVO is one of the best, still highlighting the industry as a whole, again, not being good in the last 5 years. But over the last 10 years, you could argue some of them have been fairly strong. AstraZeneca up 201%, but again, majority not really where you would have wanted your money. Pfizer, for example, up only 13%, and that is after reinvesting those dividends. So lots for consideration, and we'll also just talk about some of the underlying metrics, where firstly, if you do believe a recession is due soon, how they performed in the most recent one. Well, they increased the dividend. They had plus 6% sales, well above the average, where the S&P was negative 12, and they massively outperformed in terms of recession return, negative 27, when the S&P itself returned negative 55. Dividend growth is also something investors love to see, and at this rate, over the last year is up 22%, over the last 5 the same, and on average, over the last 10 years, dividend itself is up 16% year on year. And what makes it even better is that they are a dividend aristocrat with 25 plus years of increasing it on a consecutive basis. Now, free cash flow pal is important to have a quick look given the yield is getting higher and higher. Below 60% is what we want, because ultimately if it gets above that, there is a question of potential dividend cut, and we can see over the next 12 months expected 90%. That is definitely something we would say just to bear in mind. It isn't a massive red flag indicator, but as we said, the ideal case here is to see it around the 60%. Free cash flow, we want consistent growth over the longer term. We get it for the large part, but again, worth flagging over the next year, expected to drop fairly significantly, and sales growth, whilst we do get strong double digit from 2021 expected in 2025, we can see historically they have gone through periods where revenue growth has been a bit of a struggle. Now we'll cover total sales in a different format, but just quickly looking at the shares outstanding, because we love it when companies return excess cash. They've done it quite consistently, not massively, but always an added bonus, especially in fact a company that offers double-digit increases. We do hope that given the share price has been hit hard, that we will see share buybacks ramp up and very strongly. And ROIC so strong. We want to see a minimum of 10%. Yes, it's been decreasing, but always good to see in fact here very high 44%. Gives us faith management are able to effectively allocate their capital. Operating margin also minimum of 12%. We get to see not only that, but increasing very strong efficiencies have been noted. Free cash flow margin, no worries whatsoever, well above the minimum 5%. And then we get to the net debt to EBITDA. Well, as you can see, we want below 3. That is what we get. They are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.45 expected over the next year, so a bit of a decrease. No worries, although factor in this correlates to dividend safety and balance sheet strength, but as always, something we would say to keep an eye on a rolling basis. We also want to do a quick income statement balance sheet analysis, where revenue has been growing over the long term, as we've highlighted, nearly 3 times from 16 billion to 40 billion. Also expected to grow, as we can see, based on the trailing 12 month. But you should also have a quick look for any company either you've got in your portfolio or are considering. Does the bottom line net income follow the same pattern? And the answer here is a yes. In fact, nearly tripled as well the bottom line, 5 billion, now sitting at 14 in December 2024 accounts, and projected to grow trailing 12 month sitting at 15.2. The other thing is a quick health check, total cash versus total debt, which has doubled, 3 billion, now sitting at 6 in the latest quarter. And as always, one number here in pure isolation gives absolutely nothing away, so we compare it to their total debt numerically and directionally, which as we can see has shot up in just the last few years. 156 million in 2015, 17.2 billion in the latest quarter. That is why, as we said, for the net debt to EBITDA, definitely something to keep an eye on. Just before we get to our valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move into our valuation, where intrinsically it sits at $53, derived from the DCF model. Now we're going to highlight two different models. The first one is based on the updated guidance where their free cash flow has been reduced and quite significantly, and we'll also highlight, for those that are interested, the previous guidance where it did sit around the 10 billion in 2025 to really showcase two different things. Firstly, if you believe this is not an isolated event, we will go through the first one, and if you believe they're going to get back to how they were previously, then the other model may be more appropriate. So we have the free cash flow year on year. Now average growth 10%, we've gone 14% moving forwards, in line with analyst expectations, but you can see low, medium and high 12, 14, 16 respectively. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for NVO or any others, but based on 14% and the discount rate, we get the present value of future free cash flow and terminal price. Add together the cash, subtract total debt, get to the equity value, divide by the shares outstanding, $53, indicating 15% upside. Also worth flagging here that the reverse DCF model highlights baked into the numbers right now is 11.9% growth year on year. So if you believe ultimately it should be a lot higher, then you see it as undervalued. If you believe this should be a lot lower, then you see this in fact as overvalued. Also worth flagging here, at 12% it comes to 46.24, saying no upside, and for those that believe it should be a lot higher, at 16, $60. Now, as typical on the channel, we do take through the middle rate, which comes to 14%. Not done, because we apply a 10% MOS, execute on that if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at 47.36, and then we keep going till it's near the current trading price, and ultimately we're saying in today's episode, after their earnings release and the drop we're getting, it's sitting between a 10 to 15%. Now we'll also flag for consistency at 20%, a buy at 42, at 25, a buy around the $40 mark. Wall Street though, they remain very bullish, even though they do continue to readjust their price target. They see this at $73 into next year, upside of 59%. So give us your thoughts on this first model, whether you see Novo Nordisk as a buy, hold or avoid. And then if we move on to the other model, now this is using their previous guidance, and this will be more attuned for those investors that see this as a one-off isolated event. Now using the 14% that we used in the previous model, we get to $82. If we use the 12%, the low rate, again showing for transparency, 72, 57% upside. And for those that believe the higher rate is applicable, 93, 102%, meaning more than a double. So using the 14%, we will take that through to the MOS calculation, but as you can see and expected, given a higher free cash flow year on year, the reverse DCF is coming lower, meaning only 5% is baked into the numbers. No surprise as well, in terms of the margin of safety, it will be higher than the previous model. We are factoring in more growth, factoring in a higher starting point. At 40%, still a buy, we're talking around a 45% margin of safety. Wall Street, their price target remains the same. Let us know your overall thoughts on NVO, Novo Nordisk, the Danish pharma giant. In your view, a buy, hold or avoid? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.